Ladies and gentlemen, traders and investors, a very warm welcome to our channel Paulo Vega. On today's video presentation, we shall talk about different kinds of options with simple uses like that of going long on call and put options, going short on call and put options, and then use a combination of stocks protected by different options like covered calls, covered puts, and finally the collar, which is going long on a stock with buying a put option and selling a call options. But before we talk about these options, we shall first visit different charts which shall comprise of the Nasdaq, the S&P 500, the Indian index Nifty, the Sensex, US dollar index, and the gold and silver trades which have gone divergent during this week. While silver is managed to find a lot of mojo both in the upward as well as the downward direction, but gold has been struggling to find an impetus in either of the directions. We shall also talk about cable, which is the GBP/USD currency pair. There's been not much of a progress on the US-Iran negotiations, hence the trouble with gold finding a direction. But also there has been an imposition of import tariffs on gold by the Indian government, which has reduced the volume of gold trades during this week. We shall touch upon all of these once we've finished talking about different charts and different trades that attracted our attention during this week. Disclaimer/disclosure. The contents of the presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the 42nd of a series of videos aimed at educating our viewers, and we'd like to warn all our viewers of the risk associated with the business of trading and investment. Securities investment and trading is a highly risky business, and there exists a possibility of total/partial losses of investment. The ideas and the opinions in our video are solely based on our analysis of the market, and we do not advise/recommend/guide anyone to take any trades based on the contents of the video, and we do not take any responsibility for the partial/total losses arising out of trades based on the contents of the video. Traders and investors, the chart that we see in front of us is that of Dixie, the US dollar index, and there has been a change in the direction of the index during last week as it managed to turn from its halfway level of the range that it has been following since April last year, and it has printed some nice continuous green candles from Tuesday up until Friday, and we as of now are approaching the upper level or the upper boundary of the range that it has been following, which is at 100.39. As of now, the current price is at 99.208, and there could be a chance that it could break out if the momentum remains with the index during the forthcoming week. Traders and investors, we're looking at ES, which is the ETF based on S&P 500, and we're looking at the daily chart. This particular index managed to make a new high last week, and it touched 7534.65, but it had a massive drop on Friday and erased all the gains from the previous week. Now one needs to see the formations on the lower time frame charts before trying to engage in a long on the index or try to take any bullish trade, as there has been a nice drop, rally based drop and a drop based drop formation, and if it manages to go down further with an explosive red candle, then this could be the beginning of a new downtrend or a new correction to the uptrend, and one must wait and watch it arrive into a new demand zone before going for a long. Otherwise, we could be looking at shorting at the new supply zones formed on the index. Traders and investors, the chart that we see in front of us is that of NQ or the Nasdaq based ETF, and we're looking at the daily chart. Compared to S&P, Nasdaq has always been stronger since the beginning of this year, and contrary to the moves made on the S&P, we can see that there was a nice red candle printed on Tuesday of the week, but it managed to erase all its losses and finally made a new high on Thursday, which is at 29782.76, but it couldn't stay there and has managed to take away more or less all of the gains made last week and is currently at 29231 after touching 29054. In case we looking at an entry into the index, we should not try to engage right away but see the signs of reversal, if any, on the lower time frames, and if it reverses, then we cannot go long any further. If there are supplies formed after the rally based drop and the drop based drop that was formed on Thursday and Friday of last week on the 2-4 minute chart, there could be a possibility of making another drop based drop, and that would be the beginning of a correction on the index. Traders and investors, the chart that we see in front of us is that of Nifty or the NSE 100, which is the Indian index, which kind of tries to emulate the Nasdaq in the US. It has got all the IT firms listed, or the Indian IT firms listed on it, and what we can see from the last few weeks that it has shown a lot of weakness until the government intervention happened on Tuesday or Wednesday of this week, which allowed it to stop its downward move and managed to print some green dojis on Wednesday and Thursday, followed by a red one on Friday. The government of India had to intervene because of the depletion of its forex reserve, and it managed to do so by imposing restriction on gold trades, on foreign travel, and with the increase of import tariff on gold from 6% to 15%. This is the idea to retain its forex reserve as far as practicable and help the stock market regain its confidence. But one needs to wait and see if it manages to regain its lost strength or continues with its downtrend under the influence of the strong dollar abroad and the lack of foreign investment which it has been thriving upon for the last couple of years. We still have got on the technical side a nice supply at 24192, and the stop loss could go above 24460 if it manages to retrace its way back into this zone. Otherwise, if it continues with its downtrend, then there's a nice demand zone from May 2025, which is between 22143 and 21761, where one can expect a bounce from the downward travel or a temporary pause to the downward travel of the index. The chart that we see in front of us is that of Sensex, and we're looking at the daily chart. This is in line with the S&P 500 of the US, and it is the older index from India, which has all kinds of traditional stocks and the heavyweights listed on it. As one can see that the move of S&P 500, which is got a lesser impetus as compared to the Nasdaq. Similarly, the Sensex has got a lesser momentum as compared to Nifty, but it managed to fall quite a bit during the last 2 weeks until the intervention by the government of India, as explained on the chart for Nifty. Similarly, the gold trade here as well has managed to stop the downtrend for a bit, and we still need to see as to how the index behaves during the forthcoming weeks. If it manages to retrace back to its old supply zone between 77307 and 78433, or if it continues down to see a bounce at the demand zone between 73195 71481, which was formed in the month of May and was later visited by the index in the month of April this year, to see a small bounce all the way up to 7900, to go sideways after that and then again continue with the downtrend. Since there has been a lack of interest by the foreign investors and a shortage of foreign reserve, with most of the buying going into gold, people have shown a lesser amount of interest on the index, on the stocks listed on the Sensex. That's been determined as one of the reasons for the recent fall in the prices of various stocks listed on the exchange. We still need to see if the government intervention helps the Sensex gain its lost strength or whether it continues to weaken further. Traders and investors, the chart that we're looking at is that of XAU/USD, which is the gold based ETF, and we're looking at the daily chart. As we can see that this particular metal has printed 4 continuous red candles, of which the strongest drop was on Friday, where it managed to touch 4510 before taking a bounce. Gold hasn't seen much of impetus during the last couple of weeks, and we have been struggling to find direction on either side. Therefore, one needs to wait and watch if it manages to drop down below this area of 4500, which it has touched for the third time in the last 3 months, and one needs to wait and see if it reverses from here or it goes below 4500 to revisit the area of 4000, which it visited in the month of March 2026. But as of now, the only trade that we can see is the short at about 4800. If it manages to bounce back into this area with a strong dollar expected for the rest of the year. Traders and investors, the chart that we see in front of us is the XAG/USD, is the silver based ETF, and we're looking at the daily chart. The only reason that we're visiting this chart after visiting gold is to see the amount of mojo that this particular metal has enjoyed during last 1 week, with some lovely moves to the upside as well as to the lower end as well. It has had some very good rallies on Monday, followed by some dojis on Tuesday and Wednesday, and then some explosive drops on Thursday and Friday. So irrespective of the move of the dollar during the first part of the week, it managed to touch a fresh high in recent times, and that was around 90, and it has again erased all its losses and come back to the area of 75. There is a lovely demand zone at about 72.8, and the stop loss could go below 66.6 on the daily time frame, but otherwise, if one wishes to try and keep the stop loss at a tight level, we could enter at 72.8, and we could have a stop loss below 70.5 or at 70 to be precise, because of the chances that this particular metal has been given in the last few days. We could see some bounce out of this demand zone before it tries to go back if the dollar continues with its strength over the rest of the week. Traders and investors, the chart that we see in front of us is that of GBP USD, or the cable. The currency pair has seen a lot of bearish moves during last week, with 4 continuous red candles printed on the back of the strong US dollar, as well as the current political situation in Great Britain, and we could look for a reversal when it touches the demand zone between 1.322 and 1.3159. There is a chance of a strong reversal, because that was the beginning of the upward move during the last 3 weeks, where it printed some nice blue candles followed by a sideways move for 2 weeks, and now it has dropped. It is coming back into this demand zone, and the zone is absolutely fresh with a lot of buy orders stacked up after it left with some nice explosive candles in the beginning of April 2026. As of now, we should not go for a short trade unless it reverses from the current position and goes back into the supply at about 1.3540. That's the entry for a supply if at all somebody wishes to short the GBP USD pair. Traders and investors, the diagram or the graph that we see in front of us is that of time decay curve of an option. The option premium is at its highest when the contract is exchanged between the buyer and seller at the beginning of the contract. And then theta, as we all know, starts playing its role on the price of an option premium. The option premium starts declining at almost a flat rate or at a very shallow pace for the first few days, or say in case of a 90 days option, the first 30 days are relatively flat, and then the gradient starts getting sharper between the 30th to the 60th day. As we can see on the curve, the graph has got a slightly higher acceleration of the price depreciating, and finally during the next 30 days we can see that there's a sharp drop which is almost 70 to 80 degrees from the horizontal, and this is the accelerated decline of the option premium during the last few days of the life of an option. So thus the highest price at the beginning of the contract and zero value at the expiration of the contract. The option has got a very important relationship with respect to theta or time. And when we trade options, we must bear in mind the time at which we are buying or selling the call or put options, and we shall touch upon this particular part when we look at the trading of these options on the market. Traders and investors, the graphs or the charts that we see in front of us or the diagrams that we see are those of going long or short on a call option. When we go long on a call option, then we are a buyer and we have the right to buy the underlying asset at the strike price at the expiry day in case of a European option, and at or before the expiry day in case of an American option. Now, the buyer of the call option starts making a profit or starts gaining only when the current price exceeds the strike price at which the option was bought. And this is only when the buyer is bullish about the trend of the underlying asset or the stock. As long he predicts or he expects or he speculates that the stocks will go up in value, and that's when he starts making money. He breaks even when the current price and the strike price difference is equal to the option premium, and he goes into a profit when the current price exceeds this value, which was his break even value. But otherwise, if the current price stays below the strike price, he's at a loss, and his loss is equal to the price that he paid for the premium, and that's how his loss is limited to the value of the option premium that was paid while getting into the contract. But his profits, if the current price exceeds the value that he had expected, could be indefinite as long his direction is right. When somebody decides to sell a call option, then he is under an obligation to sell the underlying asset or the stock at a price equal to the strike price of the option, irrespective of the location of the current price. This is a bearish trade where the seller expects the stock price to go down when he is selling the option. He expects the stock value or the price of the stock to decline from the time that he has entered the contract up until the time the contract expires in his favor. But if the price of the stock goes up or the underlying asset goes up and it is above the strike price of the option, then the buyer of the option would exercise his right, and then the seller of the option is at a loss. In this case, his profit is limited to the value of the option premium that he has obtained from the buyer of the contract, and his loss is indefinite because if the price moves up against his speculation, and it could go up indefinitely, therefore his losses could be indefinite up until any value that is found on the day of expiry of the contract. Traders and investors, the graph or the chart that we see in front of us is that of a covered call. A covered call is a strategy when we hold in a stock or a portfolio of ETFs or a portfolio of assets and we decide to make an additional profit over and above the dividends that we obtain while keeping a stock. This strategy is mostly used when we do not expect the market to go up at a very fast rate. Basically, the market has to be more or less flat so that the seller of the call option gets to keep the stock and also gets to keep the premium that he has obtained after selling the call option to the buyer of the call option. He does not expect the current price to go well above the strike price so that the buyer of the call option can exercise his option and take away the underlying stocks with the seller of the contract. As we can see that this gives a limited profit to the seller of the option and the buyer has got a limited loss but an unlimited gain if the market does not stay flat and rises in favor of the buyer of the call option so that the current price minus the strike price is well above the option premium paid by the buyer. So this is a bearish strategy if we are selling a call option, but we do not expect the market to get too bullish. As long the current price stays below the strike price, then the seller of the call option gets to keep the premium as well as the stock. Traders and investors, the graph that we see in front of us is that of going long on a put option. A put option gives the buyer of the option the right to sell the underlying asset or stock at a given price called the strike price at or before the expiry date of the contract, depending on whether it's a European option or an American option. Because in most cases, if the price happens to be favorable to the seller of the contract can be exercised well in advance of the expiry date so that the seller can make his profit and walk away from the contract. This is a bearish strategy and the buyer of the put option speculates that the market is going to go down so that he gets to sell the stock at a strike price well above the current price. And his break-even point is when the strike price minus the current price is equal to the option premium paid by the buyer of the contract. The strategy is only successful if the current price stays well below the strike price of the put contract in question. Otherwise, the put contract needs to go expire worthless if the current price goes above the strike price and the buyer of the put option loses his option premium. Traders and investors, the graph that we see in front of us is that of going short on a put option or signing a contract to sell the underlying stock or asset at the given strike price at or before the expiry day in case of an American option and on the expiry day in case of an European option. Here, the seller of the put contract is bullish in speculation and he expects the current price to stay above the strike price so that he gets to retain his option premium and the buyer of the contract does not get to exercise his option. As long the price or the current price of the underlying asset stays above the strike price, then the buyer of the put contract will not make any profit by exercising his right to sell the underlying asset at the strike price of the contract. But if the market turns against the seller of the contract and the price heads down, then the losses incurred by the seller of the put premium is indefinite and it could reach an astronomical value if the stock trades at or near zero value for some reason or the other. Therefore, the profit or the reward from the contract to the seller of a put option is limited to the amount of the option premium that he sells at, and his losses could be indefinite if the price happens to go well below the strike price of the contract and the buyer of the put option gets to exercise his option when the strike price minus the current price is greater than the option premium paid by the buyer of the contract. Traders and investors, the graph or the chart that we see in front of us is that of a covered put. In case of a covered put, what we do is we are short on the underlying, the stock or the asset, and then we sell a put option on the same underlying. It's exactly the opposite of what we do in case of a covered call, where we are long on the underlying and we sell a call option on the underlying. In case of the covered call, what we do is, to safeguard our profit, what we do is we take the strike price to be equal to the purchase price plus the profit that we wish to take on the underlying asset. So for example, if it was $100 a purchase price and we wanted a profit of $5 on the stock, then we would agree a strike price of 105, and in addition to that we make a profit by getting the premium on the call option. Likewise, in case of a put option, what we do is we are short, say at $100, then we'd like to keep the strike price at about 95 so that we make a profit of about $5 on the short and the additional profit by selling the put option on the underlying asset. The difference between the two strategies is that here we expect the market to be slightly bearish and we do not want the strike price to be lower than the current price. In case the market rallies suddenly and the current price goes well above the strike price, then we are at a loss. Although the premium lessens our losses or mitigates our losses, but the losses could be indefinite and the gain is only limited to the amount of option premium that we get from the trade. Therefore, it's a very risky strategy, and in most countries where the exchange does not allow you to trade an option or to write an option without holding the underlying stock, you cannot try this strategy. And one needs to be very careful in case you are allowed to go for a short without holding the underlying stock and then sell a premium on the stock, because the losses could be infinitely high if the market suddenly decides to rally against you. Traders and investors, the graph that we see in front of us is called a protective collar, and it's a medium-term strategy where we are long an underlying stock and we want to maintain a certain amount of gain on the profit made on the stock. So what we do is we sell a call option for a particular premium. Typically, when we start looking at implementing the strategies, we'll come to it, but the call option that we sell is for an out of the money option, and at the same time we buy a put option which is again an out of the money option. The idea is to limit the gain as well as the losses in case the market goes against us, and the strategy works for free if we manage to sell the call option for a premium which is equal to the premium at which we buy the put option. Otherwise, we will lose the net premium as well if the market turns against us while holding the stock. So what we do is we're long a stock, number one. Number two, we sell a call option OTM, and number three, we buy a put option OTM, and we cap our losses as well as our gains, and we expect the market to not rally or drop at a sudden rate. Is a strategy when the medium term risk is more or less flat. Traders and investors, we thank you for watching all our videos so far, and we feel that we should bring to you as many strategies as possible so that you can improve upon your trading skills and have better chances of success at all your trades. We hope that you've been finding all our videos informative and exciting enough each week when you watch them, and you can come back to them whenever you have the time to look at your trades and be guided by the contents of our video. We would request you to please press the button underneath to subscribe to our channel Polo Vega, and get in touch with us through our Twitter handle @Polo Vega. You may also visit us at our website www.polovega.com and email us at vega@polovega.com. We thank you for watching all our videos, and please like, share and subscribe to our channel Polo Vega.